Okay, so let's go ahead and get started. Thanks again for coming. Welcome to day 2 of Briggs & Veselka's Nonprofit Bootcamp Lunch and Learn series. We really appreciate you joining us today. I hope you had a great day yesterday at the day 1. For those of you who don't know me, my name is Jonna Kelly. I'm an advisory senior manager and part of B&B's dedicated nonprofit practice. As Deborah Seefeld mentioned yesterday, our dedicated nonprofit practice serves over 300 nonprofit engagements. So our intention today with this event is to bring together leaders in the industry who can share their stories and lessons learned for the larger nonprofit community and the missions that they serve. I've got a couple quick items of housekeeping that I want to point out before we get started and as people continue to join. First of all, we'll be showing a polling question throughout the event. Please be sure to participate and to qualify for CPE credits. It also helps to kind of get that feedback. You can also participate whether you need a CPE or not. You are muted, so please submit all of your questions through the Q&A section of your webinar toolbar. And lastly, presentations and the event recording will be emailed out to all participants tomorrow. So with that, I'd like to start now. Hopefully we have given everybody enough time to join us. I don't want you to miss this part, but it is my great pleasure to welcome Luke Redus as he shares how he built a volunteer engagement to support the mission of your organization. Luke is the founder and executive director of Compassion United. It's a Montgomery County-based nonprofit dedicated to empowering and equipping the poor and homeless to discover a new life that will restore their hope and transform their future. Luke previously worked in the tech industry, but has since committed his full attention in life to serving the forgotten and marginalized in our community. Having been homeless himself, Luke can identify the struggles and the mindsets that affect those in this area and help them see how to overcome it. Luke's been married 25 years. Luke and his wife, Carla, have 3 great children, and Luke has a passion for serving nonprofits. His mantra is do good well, as he coaches other leaders in the community who have a passion to make a difference. He's currently working toward his master's degree in organizational leadership. Luke, we're ready for you to share your slides and give us some of your presentation, and then we'll end at the end with some Q&A. Thank you for coming, Luke.
Great, thank you. Thank you for having me. Good morning. I'm so excited to be speaking with you this morning about volunteer engagement. It's an honor to have the opportunity to be in the presence of other nonprofits. I truly believe that nonprofit organizations are the heart of our community and the catalyst for change. You know, we've all had that Popeye moment where we've seen something in our community or in society and said, you know, I've had all I can stands and I can't stands no more. That reference might not land on some of you younger folks. You know, and we've all had to do something about it, but we can't do that without the resources of businesses, of churches, and of individuals who are inspired by our passion and our holy discontent, and who are willing to come alongside us with their time, their talents, and their treasures to make this world a better place. So when I met with Deborah Seefeld and asked her how she wanted this session to go, she said, just tell the story. So I'm going to take a few moments to share the Compassion United story with you, and you'll see how this journey has been empowered through the engagement of those in our community who are willing to make a difference. So Compassion United began on January the 7th, 2006. My wife and I had been wanting to do something to serve the underprivileged and the under-resourced in our community, but we didn't really know how we should go about it. We went to the leadership of the church that we attended and were told that that was only done on Easter and Thanksgiving. And we had this nagging suspicion that people might be hungry the 263 other days of the year, so we decided that we would do something. At that time, I was a project manager for an IT company, and my wife was a special education teacher. And we had no intention of starting a thing. We just wanted to do what we could, when we could, with what we had. So we woke up on Saturday morning. We went to Walmart. We bought 5 dozen eggs, 200 flour tortillas, 2 3-pound bags of tater tots, some aluminum foil, and we spent $27.54. We went home, we cooked it all up and made 200 potato and egg tacos. We then loaded our 3 kids up in the family Ford Expedition and went to go find some hungry folks. And as you probably have guessed, we found them. And as we drove through the streets of Conroe, Texas, we began to see people everywhere. So this became our Saturday routine. Now, after a few months, the folks from our church found out about what we were doing. And all of a sudden, we had something that we never dreamed we would have: volunteers. This was new, and it was exciting, and it was terrifying. But with these new additions to the team, we established a different way to serve that would build a sense of community for both the volunteers and the homeless. So what this looked like was, instead of driving all over town, we began meeting at a city park and serving breakfast from there. And on our first Saturday, we had 9 volunteers and 12 homeless folks show up. And now, 15 years later, we serve between 80 and 120 people and have every breakfast event sponsored by a local church, a business, a small group, or a civic organization at least 3 months in advance. And from this, everything else grew. So Matthew Barnett with the LA Dream Center would say, find a need, fill it, find a hurt, heal it. And that became a mantra for us. And as we were out in the community, we felt like in order to affect change in the lives whom we serve, we would need to be available to them more than just on Saturdays. So in 2009, we launched a church that would serve them 6 days per week, providing breakfast, clothing, hygiene items, encouragement, and hope. And after a year of that, we felt like there were people who were ready to make a change in their lives, but there was no real mechanism for them to do so. So we started opening transition homes in 2010. Soon we had a home for men, a home for women, and a maternity home for women in crisis pregnancy. Then, in an effort to prevent future homelessness, we launched programs to serve children in at-risk communities in 2012. In 2015, we launched a food pantry and an empowerment program that operates as a supportive service to our transition homes. So, to review the math, from 2006 to 2015, we launched a weekly breakfast outreach to the homeless that served up to 120 people a week. A church for the homeless that would meet Monday through Friday and provide necessary relief services, as well as relational and emotional support. 3 transition homes that were safe, sober living facilities for those being empowered out of homelessness to live while they got on their feet. An outreach to at-risk youth and children that served up to 70 children 3 times per week with food and after-school programs. A food pantry that served the residential poor that provided 1 million pounds of groceries last year, and a supportive service that offered education, mentorship, and support to those in our transition program. And here's the kicker. Until 2014, we had no salaried staff. That year, we hired a bookkeeper. And of course, since then, we've had to hire more people. And in 2020, my wife and I finally received a salary. But the foundation of this organization was built by people who walked alongside us and expected nothing in return. And that foundation has led us to where we are today. In 2017, we experienced the reawakening of a dream that we had had many years earlier. And that dream was to have one campus that would host all of the services needed to successfully empower someone out of homelessness in one site. And that campus would be called Miracle City. Once complete, Miracle City will be the first of its kind whole person transformation community for Montgomery County, focused on serving the forgotten and marginalized, the unsheltered, and the hopeless through outreach, relief, and empowerment. And there's currently nothing like that in our community. In fact, city leaders have said that the concept of Miracle City could be a model for communities across the nation to address poverty and homelessness on a much broader level. They felt so confident in fact that they granted us 5 acres of land to see this dream come to fruition. This campus will allow people to live and work in a grace-based, inspiring environment where they'll develop emotional and spiritual maturity, life skills, and work experience as they discover the abundant life that's available to them. Our residential capacity will expand from 17 to 92 people. We've already begun construction on our empowerment center. Our day center and at least one of our transition homes are scheduled to begin construction in 2022. And our plan is to have the project completed by 2024. And none of this would have been possible without the faithful people who have volunteered their time to see the lives of others transformed. So at Compassion United, we have adopted a values-driven culture. And since 2016, we have worked to establish the values that we desire to shape our culture. And in the process, we've identified what we call components of culture. These are aspects of our culture that must never be abandoned for the sake of increased activity. Rather, our growth, the growth as an organism, will always be guided and tempered by these components. And one of those components is family. This exists in every relationship that we have, whether it be staff, volunteers, residents, or our unsheltered friends. They will be treated like family. And what this communicates to our volunteers is that they have a value to us that's beyond the job that they do for us. And last year, we had 1,602 volunteers who served 21,000 hours with an estimated economic impact of $534,000. As we've seen this grow over the past 16 years, there are some things that we've learned about our volunteers. And so to finish up, I want to share a few of those things with you. First, they need to feel welcome. I've shown up to volunteer events and been greeted by a gruffy person with a clipboard who said, "Sign in here," and just kind of pointed me in the direction. People need to be greeted with a warm welcome. They need to feel like they're wanted there. Next, people really need to feel like they are a part of something. An axiom that we've developed for our culture, and it's the grateful part of every prayer that we have when we're together, is that we get to do this together. There's no Luke didn't do this. This was done by all of us, and we get to do this together. When people feel like they're a part of something bigger, they're going to buy into that, and they're going to remain a part of that. Next, they need to feel like they are doing something worthwhile. Show them the why. People will give their time for a what, but they'll give their life for a why. My why is Greg. Greg was a gentleman who was homeless and hopeless, and he went through our transition program, and now Greg is on staff for another nonprofit where his job is actually helping prevent other people from becoming homeless. Another why that I have is Tia. Tia was found herself pregnant. Her parents had both passed away. She had nowhere to go. And so she came and she was a part of our transition program. Now she's got a bachelor's degree. She's got a full-time job and a beautiful 8-year-old daughter named Mia Bella. Share the whys often with your volunteers. Let them know that what they're doing is having an impact and is changing lives. And next, and this is a very important one as well, they need to feel informed, empowered to do what is expected of them. This looks like training and development. Every quarter, we offer a workshop called People Helping People that empowers people to work with people in need without enabling the behavior that might keep them there. We're developing a content library of training material. We have book recommendations. We have book discussions. We don't only want them to come and do work for us, but we want them to understand why the work is necessary and how to do it well. And last, they need to feel valued and appreciated. And one way to destroy that feeling is to have someone show up and have absolutely nothing for them to do. So it's imperative that some amount of thought and resource planning be implemented in all of this. You know, there's this temptation as nonprofit leaders, especially when we're small, get as many people there as possible so that you can somehow talk them into donating. I would encourage you to resist that temptation. They know what you're doing. Just make sure they have a job, is something for them to do, or they won't come back. And remember that they're there to support your vision. So celebrate them, show your gratitude, and they'll keep coming back, and they will give. So that's my story, and I'm sticking to it. If you have any questions for me, please don't hesitate to reach out. I would love to help in any way I can because we get to do this together. So thank you so much for your time, and I'm certain that you're going to be greatly empowered by the rest of this boot camp.
Luke, thank you so much for sharing that story. I agree, and I'm sure everyone here agrees as well, that the volunteers are really an important, integral piece of many nonprofits. I appreciate you sharing that story. Does anybody have any particular questions for Luke that we'd like to address at this moment? If not, we'll move on to our next section. We'll come back and have some Q&A time at the end. So if there's anything that pops in someone's head that we need to address to Luke, we can come back to that. The next section actually is myself and Angie. So we're going to talk to you a little bit about some important aspects of the CARES Act, which has been a big piece of this recent history, last 18 months or so. And we're also going to talk about some tax important questions. The person speaking with me today, Angie Armstrong, is a great asset to our firm. Let me tell you just a little bit about her. She brings expert tax guidance to her client engagements with many nonprofit entities, including private foundations, community organizations, and churches. Angie has previously even served as a controller of a nonprofit before she came to Briggs & Veselka, so she's acutely aware of the challenges there. She serves as a trustee of a private foundation and works closely with high net worth individuals to help them meet their charitable goals. She's going to speak about tax. I'm actually going to go ahead and get started talking a little bit about the CARES Act, PPP, and that kind of stuff that I think probably all of us, if you're watching the news at all, are pretty familiar with. Again, I'm Jonna Kelly. I am an advisory senior manager here at Briggs & Veselka, and in the advisory department, we work with nonprofits and other businesses that have accounting and advisory needs. So as you can imagine, back when the pandemic hit our country, our world, a big piece of what we started to do was support people as they were walking through particular areas such as the employee retention credit, which we're going to talk about today, and PPP forgiveness. After I get finished, I'll hand it over to Angie to talk a bit about tax. So let me give you one little heads up. This, probably everyone realizes this, I would imagine, but there's been a lot of legislation in the areas that we're going to talk about today, and it is a moving target, I constantly say. So it's an ever-evolving process. So when you do look back at some of this, you do have to keep current, but we're going to talk about the legislation as we know today. Our agenda, again, will briefly be some PPP forgiveness, with most of us are well past the point of PPP1 forgiveness, but maybe are working on PPP2 forgiveness. The employee retention tax credit, briefly hit on payroll tax deferral, just as a heads up in case you took advantage of that program. And then again, Angie will end by talking about some important areas that need to be considered in the area of tax for nonprofits. So our first slide, some important PPP dates. I think probably the question I get the most often is, what's the deadline? How much time do I have? There's a lot of busy people dealing with running the entity, running through what kind of the things that Luke talked about, getting volunteers and doing work. And it's easy to put some of these things on the back burner. And so how much time do I have? When you submit your forgiveness, it's important to remember that the lender is going to have 60 days to approve that, and then the SBA will come along and take their next step, and they have 90 days to approve. I have noticed sometimes that the SBA will take all of their 90 days and then some if they have questions, but for the most part, that's the timeline. You should keep your documentation for at least 6 years. So that's another important date to remember, because it is possible that the SBA, even though on a fully forgiven loan, could come back later and ask for some of the documents behind. To continue, the covered period, we probably all remember, was originally 8 weeks, and then fairly quickly legislatures determined that that was not enough time for everyone to use the funds, so they extended it to 24 weeks with the PPP Flexibility Act. So when do you have to apply for forgiveness? Technically, by law, you have any time during the term loan to apply. So your term loan, your PPP loan may be a 2-year or 5-year loan. You can apply during any time of that time frame, but the lender, the banker, can ask you for payments of principal and interest once 10 months at the end of your covered period have elapsed. So if you use a 24-week covered period, you've got 24 weeks plus 10 months to apply before you might have to start making payments of principal and interest. What happens if you make those payments and then get forgiven? They're returned to you. So it's not necessarily a terrible thing if you get past that date, but most of us would prefer to not have to make those payments if possible. There are currently 3 forgiveness applications. There's the full forgiveness application, the 3508. It requires a Schedule A and some supporting documentation. There is a second application called the 3508EZ that you may be eligible to use. That depends a little bit about whether you reduced FTEs or reduced salary or hourly wages. I would briefly state here that, it doesn't necessarily mean that the application will go through the process any faster. So this is anecdotal, but I work with hundreds of PPP clients, and the 3508EZ does not necessarily go through the application process any faster. And in the background, you're still responsible for doing some FTE calculations. There is a little bit easier application to fill out, but it's not a lot easier. And then I guess my favorite one is the 3508S. Only borrowers that have loans of $150,000 or less are eligible to use that application. But the nice thing about that one is you don't have to go through your lender. You can go straight to the SBA and apply for forgiveness through that process. So briefly, we probably all remember March 27th, 2020. It's kind of hard to remember the world the way it was when everything went remote and everything shut down, and there was rarely even anybody on the roads. But on March 27th, the CARES Act provided for not only PPP, as we're all aware of, but the employee retention credit. However, early on, you weren't allowed to take both. So most people chose PPP. The funds came right away. You didn't have to wait. So there's definitely an advantage to PPP for tax purposes over ERC. So most people, when they were choosing between the two, I would say predominantly chose PPP. Later, on December 27th, the ERC, the Employee Retention Credit, became eligible to all people, even if you had a PPP loan. So if you remember late in the year last year, that was the big news, that now everyone's eligible, and not only in a future standpoint, but even retrospectively. Several notices have come from the IRS. One thing I say constantly to the people I work with is that it's important to remember that a PPP loan goes through the SBA and the Employee Retention Credit goes through the IRS. And those are similar, but definitely different entities. You want to remember who you're dealing with as you go through that process. So you want to be watching the IRS notices that have been released. There's been quite a few related to the Employee Retention Credit. And the Employee Retention Credit is actually on the current infrastructure bill in some capacity, in that originally the Employee Retention Credit was supposed to continue through the end of this year. The bill as it stands currently has an end to that credit on 9/30/2021. There has been some movement by some legislatures to consider leaving that in there for the fourth quarter, which to me seems fair since we're already in the fourth quarter, but we don't know how that will play out. So it's possible there will be no Q4 2021. We'll have to wait and see. How do you know if you're eligible for this credit? It's a great credit. It's definitely worth having a conversation with your CPA about, is this credit something that we might be able to take? So the credit is written eligible trade or business, which for nonprofits immediately caused some concern. You know, what is that something I can take? And they came through, the IRS did, and said a tax exempt organization is deemed to be engaged in trade or business with respect to all operations. So as a nonprofit, yes, you do have an eligible business. The next thing you need to consider is a small versus large status. So one of the things about the Employee Retention Credit is it's fairly complicated. The way it works in 2020 and the way it works in 2021 is different. In 2020, a small business is defined as anyone with 100 or fewer FTEs. And in 2021, a small business is defined as 500 or fewer. Well, what year do you look at to figure out how many FTEs? It's not the year that you're asking the credit. You're going to go back to the pre-pandemic year of 2019 and look at how many FTEs you had. Now, why does this matter? Well, if you're considered a large business in either 2020 or 2021, you can only take the credit on wages you paid someone virtually to not work at all. So maybe you had a valued employee, you said, go home, there's nothing for you to do, but I'm going to keep paying you. And they literally did nothing, not went home and teleworked, but went home and did nothing. If you're a large employer, those are the only wages you can take the credit on. If you're a small employer, you get the credit on all the wages, which is by far a better situation. So there's two ways to be eligible for the credit. So we've already determined that you're an eligible business as a nonprofit. We've already determined perhaps that you're a small business. Well, now, do you meet the criteria? Further criteria required. There's two ways. One is either a full or partial suspension, and the second is a revenue reduction. You don't have to meet both. You have to meet one or the other. Well, what is a partial suspension? A partial suspension is when the employer, the nonprofit in this case, cannot function in the normal continued operations due to COVID. And it has to be because of some kind of government order. And so the employer is going to look for proof of that government order that says, the easiest one to use as an example is in a restaurant. You probably all remember that, restaurants were at limited capacity. That was a partial closure. There may have been reasons that a nonprofit could not be open for a span of time. And it would be the same measurement. It has to meet a more than nominal effect, which originally wasn't defined very well, but later they came along and said that a nominal effect, you can see here in red, is when the gross receipts from that business have at least a 10% reduction or the hours of service. So you're looking for at least a 10% difference in your activity. The other way, and probably the more common way to claim the employee retention credit and be eligible, is if you meet the gross receipts test. To meet the gross receipts test, you either have to have a 50% reduction in gross receipts when you're looking at 2020 quarters, or a 20%, it got easier to get the credit in 2021. And there's some alternate calculations. For the sake of time, I'm not going to go into great detail about those, but basically start looking at your quarterly revenues, talk with your CPA, you may be eligible based on the gross receipts test. And carefully consider what a gross receipt is. I have a quick slide here for nonprofits. The items that are considered gross receipts are pretty much all of the activities, less returns and allowance, plus investment income, grants, gifts, and so forth. The wages that are claimed, the important thing to remember here is you can't double dip. As you can imagine, if you paid John Smith $10,000, then you used those wages to claim PPP forgiveness. You can't now turn around and also ask for the employee retention credit on the same wages. And there's a lot of other overlap that you have to be careful of, but that's predominantly the one that most people find they need to be careful about. This is a brief comparison. I said earlier that the rules changed between 2020 and 2021. So this is a brief slide that kind of gives you an idea of the comparison between, there's differences in large employers, the gross receipts test, and even the amount of credit. You can get $10,000 per employee annually, or you can allocate $10,000 per employee annually to the wages and take a 50% credit. So that's $5,000 per employee for the whole year of 2020. But in 2021, you could get up to $7,000 per employee every quarter. So it's definitely a significant credit worth considering. Again, you want to be sure that whatever you've claimed on PPP forgiveness does not double dip. And a lot of people immediately said, well, I already filed my PPP forgiveness. I didn't even know I was going to be able to take the employee retention credit. Unfortunately, the IRS didn't budge. They didn't let you start the process over and maybe include some non-payroll, but they will let you use the lesser of the payroll expenses or the loan amount. So for instance, if you had a $500,000 loan, but you put $800,000 of payroll expenses, you don't have to allocate $800,000 to PPP. You can just go with the lesser, the $500,000. How do you claim it? This is the second most asked question, I would say, about this. Beyond, am I eligible? How am I going to get the money? Is it part of a federal return? It's actually part of a payroll tax return that you'll have to amend. You will be able to claim this credit for 3 years from the day you filed your original return. So a lot of people are like, what's the deadline for claiming the credit? You'd actually have a long runway here and some time to work through this. Another thing to remember is that the IRS has also extended the timeline for auditing these. So it used to be 3 years, they've extended it to 5. So you want to keep good records. It's important to remember when you're accounting for the employee retention credit that, when do I claim the income? When do I put what happens to the expenses? So for book purposes, generally on a very high level, once you've determined that you're eligible or owed the credit, then an entry should be made that basically debits a receivable and credits the grant. But for tax purposes, it's important to remember that that income is not going to be taxable. So when you do get the credit, it's not going to be taxable to the entity. However, the expenses that you are using to claim the credit, so that are equal to the amount of credit, are no longer a part of your tax deduction. So that can cause obviously a book tax difference. And lastly, let me just briefly say that if you took advantage of the delaying your payment of payroll tax, there was a payroll tax deferral, you may or may not have participated in this program. One really important highlight I want to point out before I turn it over to Angie, and that is that you have to make payments equal to 50% of that deferral, and they're coming up fairly quickly. The first half is due December 31st of this year. The second half is December 31st of the next year. And the reason I'm calling this out is because the penalties are particularly egregious. If you decide for some reason you can't get that money in on time, they're going to charge you penalties back to the date that they were actually due. So it doesn't start like, oh, I was a day late. The penalties are going to go back to when you were actually accruing them. So they can be pretty heavy. You definitely want to make sure to make those payments in advance. So Angie, I'd like to turn over to you now a little bit on your tax update.
Thank you, John. I appreciate it. If you remember yesterday, Deborah told you that she stays up at night, can't sleep when she worries about her tax exempt clients having cybersecurity issues, or she's worried that you're going to do something and she's going to read about you on the front page of the paper. I'm a tax geek, so I lay awake worrying about your unrelated business income tax. So the thing that we have really noticed this year, 2021, after ERC and PPP, the next asked question really came to unrelated business income tax. I think it was in the news a little bit. People were asking, and we've unfortunately uncovered some unrelated business income tax for some of our clients. And one of the biggest areas where we're seeing unrelated business income is related to sponsorships. So I wanted to take just a moment today and spend a little bit of time talking about sponsorship and how that's different than advertising. And the first message is your sponsorship agreements are an agreement that you share with your sponsor that tells what they're going to provide, money, yay, and then what you're going to provide. And you will provide some benefits. You might invite them to your gala. You might put their advertising in your publications. There's going to be an exchange in that agreement of benefits. So we're going to talk about this over the next few minutes, but really here, when you're looking at what is a sponsorship and what is advertising, remember that advertising is when you're going too far. You're telling your guests at the gala, for example, that everybody needs to go shop at our sponsor over here, and they're going to give you a coupon and you're going to go save some money, but they are our sponsor and you want to go shop with them. That's over the line. That's advertising, and that's not going to be excluded from unrelated business income tax as sponsorship income. So what can you do? I'm sorry, this is the slide for what can you not do. As soon as I saw advertise, I'm like, no, we better not do that. This is what you cannot do with your sponsors. You do not want to advertise. And in the tax exempt world, there's a lot of gray area around these exclusive provider agreements, but most of our clients are of a size that they're not going to be offering these. This would be something like sponsoring the Cotton Bowl. But you don't want to get into exclusive agreements unless you're going to get with an attorney and make sure you draw those up just right. You're also not going to give the rights away to use your name or logo, because that's you're going over into advertising rather than keeping it in the lane of sponsorship. So what's not advertising? These are the things we want to do. What's good? You can acknowledge them. You can thank them. You can use their name, logo, product. You can, if you're a country club and you're having a gala, you can park their cars in front of the entrance so that everybody sees them. You can provide name, address, phone, and here's the most popular question this year is, what about their website? Yes, you can list their website. So any of your printed materials, you can put their website. You can link. So on your website, you can link to their website. But one of the things that I find is you want to link to their homepage. You don't want to link to their sales page because you're going over into advertising. So make sure your link works properly and you're not just trying to sell their products for them. Like we said, we can display their products and you're welcome to take their free samples. So here's the things we want to avoid, which we've kind of talked about a little bit, but you just don't want to promote them. You're not going to be their marketing arm. You're not going to say that you recommend them. You're just going to continue to thank them. And you don't want to take any inducements to purchase. So no coupons. Don't put coupons in your goodie bag from the gala. Don't work out an agreement where, you know, let's say Lexus is the car sitting in front of your gala and you're going to tell everybody, well, if you go buy a Lexus in 30 days, they're going to give you $10,000 off. That's advertising, not sponsorship. So let's turn that around. The sponsor can advertise its support of you. So let them drive that agreement and that advertising because they can do it. So they can say, hi, we're Lexus and we support XYZ Country Club. Go to their gala. They're going to have our cars there and you can have a free test drive. That's all okay because it comes from them. So that's the way to turn those advertising tricks around. So let's go back to our sponsorship agreement. We know that if it's a valid qualified sponsorship agreement, we're going to have no unrelated business income. But within that agreement, we can still end up with a little bit of advertising, and that's called substantial return benefit. We probably learned this a long time ago, but it kind of slips our mind that when we are working on that sponsorship agreement, there's that exchange, money for goodies. So you want to step in and look at that sponsorship agreement and assign the value that is those goodies that you're giving. And if you're giving more than 2% of the sponsorship payment, you're entering into the substantial return benefit. So we'll just do an example here, talking about galas. We'll go back to our country club and let's just walk through how quickly you can find yourself above the 2% limit. There it is. Okay, this is an example of substantial return benefit, which is taxable, which is an exception outside of sponsorship income. So our sponsor, we're using Lexus today, is coming in at $20,000. They're going to give you $20,000 for a table at your gala. Table seats 8. And then walking through this, we need to know ticket price. We need to know the fair market value of what you're providing to them for that ticket price. Let's start with the limit though. The limit we know is 2%. So $20,000 times 2% is going to be $400. And that's not very much when you exchange 8 tickets with a fair market value of $200 a piece. So you've given them $1,600 in benefit. Even if that's your only thing you gave them, that is substantial return benefit. So that's reportable as unrelated business income. Now, luckily, we get to take the cost against that. So we know our event cost here. I worked it out to be $150 a person, so $1,200 a table. So on your 990T, you're going to be reporting $1,600 of income, cost of $12, got taxable income. Yeah, tax exempts do pay tax. So taxable income $400, you pay at the corporate tax rate of 21%. So you now owe $84 on that table. So think about how many tables you've, say it's 20, you owe $1,600. That's really, it's bad to think about that tax exempts do have to pay tax, but it's not very bad when you consider how much you sold those tables for. So maybe it's just kind of a cost of doing business that we want to stop and think about. So the takeaways today is really, when's the last time you've looked at your sponsorship agreements? Have you gone through there and calculated what you are exchanging for that sponsorship. Definitely want you to stay away from coupons. And then one thing that has just recently come up, and if you guys are on this call today, you'll know who you are, but there's these affinity programs. And the example might be Randall's or Kroger, or maybe a local business who is telling you that if you send all your members to us and they buy, we're going to return some of that money back to you. We'll make a donation back to you. And it sounds great, but that is advertising, because you have taken on advertising on behalf of a for-profit business. Now, is there a way that we might be able to work that agreement into royalty income, which is an exception from unrelated business income? Yes, probably. But I think the better answer is to think about how you can turn the whole affinity agreement into the for-profit advertising. They can advertise, and just telling everybody that they are giving a share of their proceeds back to you, and let them take the lead in that advertising. You're just merely providing a link and recognizing them as a sponsor. So those are just a quick review of some things you want to think about. And really, I would tell you that the thing that worries me is all of our tax returns are on GuideStar. You know, if I file a tax return from one of my for-profit clients, the IRS sees it. But ours are on GuideStar. We have watchdog groups out there watching what we're doing. There's also, if you think that you owe unrelated business income tax and you go ahead and you file that 990T, that starts the IRS's statute. So let's file those for a few years, and they decide to audit you and decide you should have paid for 7 years prior. You have that security of, well, I filed. It's a 3-year statute. I'm out. You can't go back to that year. And so sometimes even just filing a little bit of unrelated business income gets you started in that compliance. So thank you for your time today.
Thank you, Angie. I love that you covered those things. Any of us that work with nonprofits know that those are absolutely the questions that come up repeatedly. I did have one little question that came up in the Q&A. And I think this is a good, you and I have talked about this. It says, I thought you can say to someone, please purchase from XYZ store and we'll get 15% of sales today. I know that that happens a lot with like Kendra Scott and some of those. Can you tell everybody really quick before we turn it over to the next?
That's what we're worried about. That's exactly what we're worried about. I did see that the group who had this affinity program work well for them is online. Kendra Scott does that. You know, they're going to say, send all your members to us. We're going to give you 15% of everything they buy. Well, great. You might end up with a check for $10,000. That was advertising. Just go pay your tax. Go pay put it on your tax return, pay the tax. It was worth it to get that money in the door. But just recognize it was advertising. Okay, 2 ideas on how to avoid that. 1, go to the agreement, read it. See if there's a way that we can turn that into them renting your membership agreement. They send a postcard to your people with that advertisement that they can do. So you don't advertise. The second idea is, can we call it rent? Make it rent of your membership agreement, and that makes it a royalty, which is an exception from unrelated business income tax. So if you're getting into thousands and thousands of dollars, it's probably worth it. If you got a $15,000 and you guys didn't do a thing, you just advertised that Kendra Scott was going to give you 15%, go pay your tax. Take the money, pay your tax, and be done with it.
Like you said, it's worth it, right?
Yeah, it's worth it for the donation. So
very good. Well, thank you so much, Angie, again. And we'll have some time again at the end if there's any questions. I want to go ahead and be sure we give Brooke plenty of time. So I'm going to turn this over next and welcome Brooke Baugh to discuss virtual fundraising. Myself, I was involved in some virtual fundraising and it was a challenge. So she's from a great group. She's got over 15 years of experience in the nonprofit industry, extensive background in advertising and marketing, but her passion is really for nonprofits and for, working with them. She, as a tribute to her mother that died of breast cancer, she considers this an important part of what she does every day. She joined the Wolford group in 2017 as development consultant and works with nonprofits of all shapes and sizes, and has a passion for research and data, important, organizational efficiency, and helping nonprofits reach their fundraising potential. So Brooke, we're ready. Thank you so much for joining us.
Thank you so much for having me. The Briggs & Veselka team has done an amazing job. I've learned so much over the last couple of days, and the Wolford group is so honored to be a part of this panel. So thank you. So as mentioned, the title of my presentation is Virtual Fundraising, Limiting Risk and Ensuring Success. So I know this is very COVID-centric from the title, but we're going to go into some of the aspects of events and how it can be applied to the non-COVID world. This last 18 months has been so interesting for all of us, but especially the nonprofits that we work with at the Wolford Group. If for nothing else, it created a space where we all had to be very flexible and very creative. So some great ideas were born out of this time. So like I said, we'll talk about a case study of how a long-standing fundraising luncheon event continued success in the virtual world. You'll understand the benefits of shifting a live event to an online giving campaign, how you can successfully convert a live event into the virtual space, and the importance of having the tools and technology to be successful. So as I said, the case study I'm presenting is specific to 2020, but we're going to touch on many points that go through ROI, risk assessment, and have you really look at your events from a holistic approach. So as I'm saying, uncertain climates always exist. So here in the recent past, it's vaccination rates. Are we having surges where we're not able to host events in this past year? But living in the greater Houston area, we've always had threats of unforeseen events. There have been years where we've had luncheons or galas scheduled and there is a hurricane that came through. And so I think we always have to be prepared for the unforeseen. National disasters have always been a part of our lives, so we always need to be on our toes and think flexibly. So the question is, why do we do special events? As nonprofits, why do we host special events? So number one is, of course, to raise money. It's part of our revenue mix. Secondly, it's to expand our network. There's always those great sponsors that bring guests and introduce someone new to our mission, and they become donors, which is fantastic. And then also to raise awareness for our mission, not only in the room for the event, but also the publicity that's gained prior to and after the event. So those are great reasons why we do special events. When we look at fourth quarter specifically, where we're in the midst of right now, being in October, where we started in Q1 versus where we are in Q4, there are many more events happening. We would just caution everyone to always have a backup from this point forward. Have a backup for how to produce something that's hybrid, to move to virtual. Make sure you have your auction on an online platform so that if you have to move, you can still have your auction. So just a few little takeaways there. And this data is from an organization called Free Will. If you're not familiar with them, you should really look at their information. They have some great things to share. So as we look at fourth quarter and we look at this past year, wondering about events. Are most of you postponing to 2022? Have you done something virtual or hybrid? Are you doing something in person with limited attendance? One thing that we recommended to some of our organizations is to bring back smaller cultivation events. If you can't have an event with 1,000 people in a ballroom, plan a series of cultivation events in people's homes where it can be intimate, people can get out, and you can still achieve your revenue goals. And then with canceled events, how are you replacing that income? So as I mentioned in this time, lots of creativity and flexibility, but we all go through times where we think there are no new ideas. And before the past 18 months, we were all kind of working with a certain set of fundraising toolbox goals and how we're getting to those revenues every year. So we were able to realize that there are so many new ideas and there's so many things that we could learn in this time. The very first virtual event that the Wolford Group did was in June of 2020. And the technology that was involved and everything that we had to do in one of our board members' backyard, I mean, I felt like we were at NASA. It was just so much going on and so much technology that was so new to us. So when we're looking at that, and being creative. Let's take that creativity into the next 10 years and figure out, what are we missing? What can we find? How can we fine tune our fundraising plans? I listened to a couple of really interesting podcasts, and one talked about adoption, and it was talking about adoption of ideas or adoption of technology. So if you've read the Simon Sinek book, Why, which Luke talked about earlier, the Why, I'm a late adopter in all ways. But it was interesting for me to find out that I lived on Zoom for the past 18 months. However, Zoom was actually released in 2012, and I had no idea that it was even there, nor was I utilizing it in any way, shape, or form. Another interesting fact that was talked about on the podcast is the mouse, the computer mouse that we all use. That was actually developed in the 1960s and came into widespread use into 1984. So what's out there right now that could help us fundraise more efficiently, work more efficiently? If you work in the nonprofit world, you know that your hours are precious, your time is precious. You're always understaffed and have much more to do than your list can provide for per day. So let's keep that creativity going as we move forward. My poll question number 1 is your organization planning a special event for fourth quarter in 2021? And if so, how are you getting that planned event out there? And then you can also say, no, we don't have an event planned. So as you guys are answering that question, I'm going to go ahead and move on, but Catherine is going to let us know our results. Just for time's sake, we're going to move on. So then, things consider for your special event. Risk assessments are wonderful to go through even in a non-COVID time. I know, the novel concept, but I think we'll keep this going forward. The safety of your guests and staff is very COVID centric. The cost of canceling events, that could be a natural disaster. It could be many different things. The risk of not holding an event. So let's talk about that. If you're doing a risk assessment and you're looking at your fundraising mix, what is the true ROI of your events? Has your event hit a plateau? Is your revenue kind of flat? You're not gaining any new donors? You know, what's going on? And has the event run its course? You may have a few donors or volunteer leadership that love this event. It is what they love to do. They may have started it with you 10 or 15 years ago, and they really want it to continue. But is it the best decision for your organization? So let's look at the first poll here. So it looks like 41% of you have a live event. 3% of you have a virtual event, 20% of you have a hybrid event, and 36% answered no, you do not have an event, or you are undecided. So as we go through this, you know, let's just kind of think about the events that you currently have. And then I was working with one organization that one of their events was actually poaching from the other. So we really worked with them and said, you know, really, let's just stick with this one event. Really, a lot of your donors are giving to both, and you're not getting the ROI on that second event. So second question is, do you expect to reach your 2021 fundraising goal? Yes or no? And as you guys are answering that, we're going to move on, and we will bring up the results in just a little bit. So when we look at events, raising funds and limiting risk, what makes the most fiscal sense? Evaluate your ROI, look at your staff costs, look at the venue costs. I know that with a couple of organizations that I'm working with, contracts are much more stringent with the venues, and they have to be. They all lost a lot of money in 2020 like everyone else, so they really have to stick to those terms of the contract. So many of you may have noticed that those contract terms are non-negotiable, regardless of the Delta surge or other things. And honestly, you know, they have to do that to stay afloat like the rest of us. So let's get into the case study. So I work on a luncheon in the Kingwood area. There are 2 in the Pinks in the Houston area. One is in the Woodlands and one is in the Kingwood area. So this was an in-person fundraising luncheon event. And in 2020, we pivoted to an online giving campaign. Now, just a little background on this organization. They did not have a donor giving program. They did not have a donor stewardship program. They also don't have any staff. And so they were 100%, with the exception of a few small grants, reliant on event revenue, what we would call a very risky revenue portfolio. So 2020 allowed the opportunity for us to talk through, okay, you have had all your eggs in the event basket. So what does this look like now? Do you have the data to launch an online giving campaign? You know, when's the last time that you did a data scrub? And so a lot of work on that. What it produced was 300 new donors for this organization, which their luncheon was at capacity at 350 attendees. So I think that's wildly interesting. We were able to secure a donor match and we had their auction online. So in 2019, they netted $96,000, and in 2020, they netted $195,000. So huge for this organization. So here's our poll. So do you expect to reach your fundraising goal in 2021? 71% of you said yes, fantastic, and 29% of you said no. So regardless of where you fall, let's think creatively and think about how to hit those goals. So as I mentioned, relied heavily on special events, did not have a donor stewardship plan, and had a risky revenue portfolio. So what I would like to share is just a statistic here from Joan Gary that your special event revenue should make up no more than 33% of your overall income. So maybe a good metric to talk about with your board and your leadership to see where are we when it comes to event revenue. So when you're looking at doing an online campaign, and an online campaign with a large magnitude, everyone's teeing up for Giving Tuesday and our year-end appeals. So a lot of this, of course, will be online this year. So first of all, first and foremost, there was a lot of talk about the board yesterday, which I thought was really great, but you have to have a consensus from your board. Your board has to be on board, and so does your committee. It's extremely important to have everyone's buy-in before you launch something of this magnitude. Secondly, you need reliable software for your donations, maybe allow for a peer-to-peer team engagement, online auctions, and then a way to capture those new donors. Like the organization I was just talking about, they had 300 new donors. So where are we going to house them? How are we going to steward them? And then compelling materials, campaign graphics, and impact stories. Luke was talking about earlier some of the stories. That is a lot of the reason why your donors give. How are their dollars making an impact? Share that with them. And then empower your board, committee, and volunteers. Very important as well. So then as we talk about how to transform your volunteers into fundraisers, some of your volunteers may already be fantastic fundraisers. They may already have this down pat. For this particular organization, as I said, it was event-centric, and it was very hard to get anyone to serve on the sponsorship committee. So we did not have a group of those who were engaged who like to ask for money or like to sell sponsorship tables. So even more of an uphill battle. But what I did know about this group of women is that they were passionate about the mission. They were passionate about the cause. They had been involved for a while. So I knew that we could create a model that could be successful. And as long as we could empower them and not make them afraid to follow through with the ask, or let them know that I or someone else from volunteer leadership would be right alongside of them. They could see me on the email. I would be on a Zoom with them. You don't have to be alone when you're making that ask, because even though I am not afraid to ask, that's not how everyone operates. So make sure that your volunteers feel comfortable in asking for money. So we did do a volunteer fundraising training. That was part of our Zoom meetings, our committee meetings. We did a volunteer fundraising training. We had the tools to help them be successful. We wanted to arm them with as much information as possible so that they felt comfortable communicating the mission, but also asking for the dollars. So we created this pink ambassadors card. It was very easy. We had these printed. There was also a digital version, but it had a lot about the mission on the front, and then how can you help on the back. QR codes are so big these days. I mean, they've been around for a while also, but now we have used them all the time. We're using them at every restaurant. We're using them. So people are very used to engaging in that way. So slap a QR code up on your Zoom presentation. Have it on, a scrolling screen at your place of, if it's a hospital or it's somewhere where you're able to get your message out on a digital screen, have that QR code there. People can scan it. People are so used to that now. Make sure you can convey your benefits to your potential donors. And I think what Angie was just talking about was so interesting. And I know that some of the accountants and auditors that we currently work with, I'm going to go through with them and make sure that all of our information is tidied up, because that was all very, very important to go through our sponsorship decks and make sure that we are doing things in the right way. And then committee incentives and team building. So we had competitions for fundraising between the ladies, and we had some prizes for them that the board agreed on. So it was really great to have that great camaraderie with the ladies and to get on every month and see where all the team was and who was raising the most money. Also, we had personalized video messages to say thank you. And this time, I know everyone has noticed, we were receiving so much information that it's hard to, pay attention to everything. So make sure you're communicating often, but also videos, photos, graphics. People have a lot more time to read and pay attention to than a lot of words. We're really working on that to make everything graphic centric. So then when we talk about early communication for maximum success, who are you asking? How do you stratify your donors? And this is different for every organization. So for this particular organization, our first to contact, their top donors gave gifts of $5,000 to $10,000 at their events. So it's different from many other events. Some of you are receiving $1 million gifts. Some of you are selling $100,000 tables. This was not the case for this organization, but that was still their top donor. So those gifts receive a personal phone call, a face-to-face meeting, if it's safe, or a Zoom, and really engage them right off the bat so they have a chance to make those lead gifts and be those lead donors. Next, anyone who has ever attended any of your events, purchased an auction item, if some of your volunteer leadership is familiar with these individuals, have them make a personal phone call, personal email to engage them. And then prospective donors, really engaging those volunteers to find new donors for you. And some of this will happen organically through your website and social media. We were able to secure a match, which is huge when you're asking for funds, knowing that their donation will have double the impact. So when you look at the statistics for the power of a match, according to Double the Donation, 84% of donors said they're more likely to donate if a match is offered, and 1 in 3 donors would give a larger gift if a match was applied to their donation. So I think that's super powerful, super powerful. And then online giving statistics. Online giving grew 21% through 2020. And then there's a little breakdown of if you're a large organization, mid-sized organization, or a small nonprofit. These are statistics I pulled from Blackbaud. But here on the right side, which I know the average person checks their phone 80 times a day, I know. And then 75% of people prefer text to emails. So that's from GiveSmart. And I do too. If I want a quick response or I want something that I can just do right off the bat, a text is easier. But I will say, I really would like them to come up with a way where we can mark our text unread, because sometimes I miss things if I glance at it. So an email you can mark unread, so email is still great. But again, if you can do those text to gives, those are great. So then how do you keep these new donors? For this organization, 300 new donors that were introduced to their organization and decided to give a gift. We say at the Wolford Group, donor stewardship or die. We do know that retention for donors is very hard. It's hard to keep people's attention. It's hard to keep them engaged. And only 24% of new online donors make a second gift. The offline donor rate is a bit higher at 27%. Why is that? Why is it in the low end of percentages that people make a second gift? Some, it's just that you didn't ask. There's lack of communication. Maybe you don't have the staff to send out those emails, send out those newsletters. Some is just incomplete donor information. You've heard the term garbage in, garbage out when it comes to technology databases and things of that sort. Your database is only as good as the information that is input. So make sure that you're really paying attention to those things. Communication plans are different for every organization. Personal phone calls are great. Video messages are great, sharing those testimonials. And then finding out how your donors prefer to be communicated with. One thing we did with an organization we were working with was help them put together a state of the organization. So it was for all their new donors and their board members. And it was a great way for them to share information, how their dollars were making an impact. And people appreciate that. They like to know that you appreciate the gift after the gift and you're not just paying attention when you're asking. So then where are we now in 2021 with our case study? We're doing an online fall campaign only. We've expanded our giving levels. We're still volunteer driven. But then as we look at 2022, they're able to expand their fundraising mix. We're planning for an in-person luncheon in October of 2022, but we're retaining the In the Loop campaign as an annual online giving campaign. This time has really allowed this organization to expand their donor base in such a wonderful way and do something that they didn't think they had the staff or the bandwidth to do. So you have to think, what type of event is going to serve your organization best? What type of fundraising revenue stream is going to serve your organization best? Consider other fundraising and communication methods. I think, like I said, this time has borne so much creativity in the way that we do things. The small cultivation events, this may be a personal thing for me, but I do love these events. They're intimate, they're usually in someone's home, and it's a really great way to connect with your donors on a very personal level. And then engage your board and your top donors to give you input and help you make a decision. Don't be afraid to reach out to some of your donors with your board's blessing and say, hey, we're thinking about doing this. What do you think? Would you support us if we did this? It's great to have buy-in from those individuals. So here's the takeaways. First and foremost, volunteers are golden. If I will say anything, the volunteers that I've been able to work with over the past 15 years are amazing. A lot of them have become close personal friends. Keep them close, appreciate them, and keep them informed. No decision's a bad decision. Make a decision and move forward boldly. Your volunteers are watching you and your donors are watching you. So once you make a decision, go for it. Donors like to be asked to be a part of the solution. Keep that in mind. Invest in technology and don't be left behind. This is a big one for me because, like I said, I'm a late adopter. I don't enjoy technology, but once I have it, I understand how efficient it can make everything that I do. And then your mission never goes away. You cannot stop fundraising. Think about all of those stories and those people that you're impacting. And then parting thoughts, determine your fundraising goal and clearly articulate what your funds will support. If you're planning an event, always have a plan B. Consider how you can expand your donor reach and how to keep those new donors. Report measured outcomes to your sponsors and other donors in a timely manner. And keep your donors connected for good, meaning the good works that you'll do and for the future to come. So for now, I would like to turn it over to any questions we might have from those of you in the audience.
Brooke, I do have a couple questions for you. Are you ready?
I'm ready.
All right. So do you have any advice on negotiating the contracts that are like canceled, the vendor contracts? Any thoughts on that?
So yes, I would encourage you right now, if you have a contract with any venue, to go through it and to really look at the fine print and really look at some of the limitations as far as, 45 days out, 60 days out, 120 days out, you're going to be responsible for this, because we all got very used to 2020, them kind of ignoring that verbiage. It is concrete and very solid at this time. So I would say review all of that and then have a conversation with your venue sooner rather than later if you feel like something is going to come up, and see what you can work out. What I've been able to work out with a couple of venues is that everything would be paid in 2021. So they would receive all of their revenue, but then the event will be held in 2022. So we're not losing any money.
Yeah, great thoughts there. So how do you propose, an online campaign? Because I totally agree, work with some nonprofits up here in the Woodlands, and you guys have worked with us. Yes. And I've seen that sort of pivot to the online campaign in a lot of areas. I mean, COVID kind of pushed some things to the forefront for all of our careers, honestly. So how do you propose something like that to the board when, to let them know that you think maybe this is a better alternative? What's that conversation like?
So I would say be very candid and transparent about why you're thinking about this. And then, if you need someone like us or another organization to come in and just have a conversation, not necessarily under contract, just share what, we have learned in this space. I think that can be helpful, but also looking at your board members will always want to look at things for the most part from a business perspective. So if you show them the ROI, if you show them those contracts, that was the main point with the organization in Kingwood for 2021, was noticing the contracts and saying, if we do have to cancel in October, if we do have to take our attendees down, this is what you're looking at losing. is the amount of money that you're looking at losing for expenses. And I don't know if that's a risk you want to take this year. So I think it's bringing it back to risk, but I think most importantly is the amount of new donors that you can engage at a smaller level, that you might get to be a recurring monthly donor, that's someone new to your organization that you have the opportunity to steward and to grow into a larger donor and supporter over time. I think that's really the best sell for an online giving campaign. And then all the publicity, all of the, exposure that you receive, where events you're really in the room or you're receiving a special invitation. So that's what I would say.
Yeah, and you brought up, canceling events. I mean, have you had experience with kind of those major sponsors, those big sponsors? You cancel an event and then you've lost them, maybe forever, maybe temporarily. How do you manage that?
So yes, we've had a couple of different things happen. We have had sponsors that were a presenting sponsor of an event that would not support the event moving into a virtual space, because they were only supporting things that continue to be in person. So I think that's one example. And then secondly, all around, I would say, have a conversation with those donors. And throughout the conversation, you'll get a read for where they're kind of landing in this space. I think it's always appropriate that you can ask them to give their donation and consider it a gift. It, at that point, will be a 100% tax deductible gift versus them having fair market value of what the event would have cost. And then secondly, Anne works with an organization that one of their donors gave a pretty substantial gift, and then in encouraging other donors to let the gift remain with the organization, she decided to give a gift of 3 times what she had previously given. Wow. So that was a great thing to share with the other donors, that, yes, not only did this person allow us to keep the gift, but they gave us more because they knew we were going to give it. So could you follow her example and agree to have your gift remain with our organization? So they're tough conversations to have, but also they're good because you can get a read on your donor and where they're at and kind of understand, how they may support you in the future as well.
Yeah, it's great. I think it's been a really challenging time for nonprofits in general. I hope that, that everybody on the call today has found some of this information to be helpful. It looks like we've got one more poll question that just popped up. And, but I wanted to thank everybody for coming. I know we started by talking about, volunteers and a great story from Luke. And then we moved into what I, even as I was the speaker, would I consider drier and less interesting information, but I hope it was helpful. The ERC and PPP and the CARES Act are certainly some helpful funds that might help bridge through some of the painful pandemic time. And that's what they're for. And then I appreciate Angie coming in and reminding us of some very small but important technical details about when do you have that unrelated business income, and just watching out and maybe just formulating your contracts in such a way to protect yourself. And then certainly thank you so much, Brooke, from the Wolford group, for your time. Just think that what you guys did during the pandemic and watching how you handled all of that was truly amazing. I don't see any more open questions, but I'm going to give it just a minute to see if anybody has any further questions that they want us to discuss today before we get rid of our panelist here. I did see a few questions about the ERC and PPP, and I answered them on the screen, but I will just circle back to kind of the subject matter of those while we wait to see if there's any more. One of the things I wanted to point out regarding the employee retention credit, people are saying this more and more often to me as we help them calculate, navigate, and request that credit. They're not receiving the funds. It's not, we don't see a very quick turnaround when you file that 941 amended payroll return and you're hoping to get that money. It's definitely, we're looking at 6 to 8 to 10 months from the time of submitting. What I would tell you, and it's not good news, and I know it's not what you want to hear, but the IRS is just as backed up as everyone else is from the pandemic. They have their own, of course, deadlines that we just finished for personal and business returns. And so they are having to look at all of those requests for the credit, those 941Xs, they're amended. So they have to be looked at by an actual human being. And that is the slowdown in the process. I do understand from some of the news releases that they have diverted some of their resources to try to get through those more quickly. But if you're finding that you requested the credit many months ago and you still haven't received it, that is not unusual. It's probably frustrating, but it is not unusual. It's different from PPP forgiveness, right? When we got all of the money right up front, and then we just had to show that we used it correctly. This is a bit of a difference. You've already spent this money and you're hoping to get some relief. So hopefully they'll relieve the bottleneck there and get some answers for you pretty soon, get you some of that funds. We did have a little quick question here, Brooke, that may be probably in your wheelhouse, most likely, if you're willing to take it. The question is, do people offer refunds for canceled events typically? Is that usually how that's handled?
As far as do the nonprofits offer refunds?
I'm assuming so, yes.
Yes, there are, if you do not have verbiage in your sponsorship or table sales, seat sales contract that says you will not provide a refund, that's definitely an open conversation. And for the most part, yes, if people request the refund, you will, it'll be in your best interest to give that back. It just creates goodwill and, a conversation for the next year. So yes, in my experience, I have only ever seen the organization refund the amount back to the donor. Good question though.
Brooke, I had a question for you.
Yes.
This has come up with the move to online auctions.
Yes.
And people who are leaving them open a little too long and they become
Yes.
a trade or business. What is your recommendation for people for that window?
Great question.
Such a good question, Angie. One of the auctions that we had last year was a very pink Christmas auction. It was great, I think, to have a themed auction because a lot of people were doing auctions, and we usually raise money for breast cancer in October. So it was nice to have it that first week in December. But yes, we had a lot of action the first couple of days. And then as auctions are, you want people to start really outbidding each other before you're closing the auction. And there wasn't that sense of urgency at the end because we had it open. That one, I think we previewed for 3 days, opened the auction. So all in all, it was 7 days. We had 4 days of open auction. So this year we are condensing that to 3 days. We're doing a preview for 1 day, and then we're opening the auction. And we're also on our end going to make sure there is a lot of communications those last 3 hours before the auction ends to make sure that people know, so-and-so is outbidding you, even though they were getting those notifications. I think it just had been open for too long and people had reached their threshold for what they were willing to pay. So good question.
Good advice. Thank you very much.
Yeah, that was a great question. I think we've answered all of the open questions that are left. I really appreciate everybody coming today. It's been a great presentation. I can personally attest to, I can hear everyone talk about this subject multiple times, and I feel like I pick up something every single time. We really, at Briggs & Veselka, the nonprofit space is important to us. I've worked with Deborah Seefeld for years, and I know that she has a heart for that space, and I appreciate her putting together this program and leading in this area. All of the presenters today are available. If you have follow-up questions, you should be able to reach out to any of us for different areas. Angie obviously leads in the tax area. I can help a lot with the accounting and advisory services you might need. And of course, the other presenters, Brooke and Luke, they are extremely helpful to us today, and I appreciate them being here. I think we're at the end. Can't believe it's here. It's been a great boot camp. We appreciate you coming. All of the presentations, as you see on the screen, will be emailed to you, as well as your CPE certificate. We are, I hope those sessions have been helpful. We really do see ourselves as part of the nonprofit community and are here to support you, and just appreciate everything that each of you are doing in that space that makes the world better. Thank you so much for coming, and goodbye.